Hello, everyone. Today on the Final Bar, we will talk about this market resuming its move to the downside here on Monday, May 9th. Those of you hoping for a different feel to this market this week after last week's deterioration, probably frustrated at this point. The NASDAQ down over 4%. The S&P closing back below the 4,000 level for the first time in many months. We're going to look at the long-term trends of some of these major indexes, identify some of the key downside objectives and what is still working. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down these markets using the power of technical analysis, using the technical toolkit to better quantify what's happening and better understand or get inside the head of investors that are pushing prices further to the downside. The market's just continuing to push down. I was arguing earlier today with Grayson Rose here at StockCharts, whether this was a capitulation sort of move or not. And the short answer for me is I don't think so. I'm thinking of some of the conversations I've had recently with my guests on StockCharts TV, some of my own work with my Market Misbehavior Premium members. I'm not seeing capitulation in that. I still think we're not through that disbelief phase, and we're maybe now getting into the acceptance phase. If you think about what happens when a market tops out, when the market initially rolls over, there's a 100% disbelief. No one believes the market's actually topping out, even as the evidence mounts that it's actually doing that. You have the quote unquote smart money taking profits, but most investors are still trained to buy on the dips. When those investors realize that buying on the dips doesn't work and that buying low has led to further lows and you just add to your losses, that's when we get to the acceptance phase, which is when people start going in the fetal position as an investor and start dumping everything you can and moving to some area of relative safety. That's where you're seeing bonds moving higher today. Pretty much all risk assets moving to the downside. We're going to get to some of the evidence here in a little bit. That's my quick take on these markets. We have some other experts that'll probably have some thoughtful words as well. Tomorrow on the 10th, we have Larry Berman from ETF Capital Management in Toronto. On Wednesday, the 11th, John Gagliardi from Fidelity Investments. And then on Thursday, the 12th, Matt Maley, editor of the Maley Report, and also from Miller Tabak in Boston. Great guests coming up, and we had a lot of fun this last week with people like Katie Stockton and others, had some really thoughtful words. So go to our on-demand platform, StockChartsTV.com, to check out some of our previous fantastic interviews. We need to continue on today's show with the market recap. Let's look at the big picture and how it's evolved. Monday's a fun day because we do three phases. We start with the big picture, talking macro evidence, and then we'll go through sector relationships and then look at individual names as well. And we'll try to touch on all of those. If you're in the Canadian markets, the TSX getting below 20,000. If you're a US-based investor, the NASDAQ composite dipping below 12,000. The S&P getting below 3,000. These are below 4,000. We're not there yet. Below 4,000, I meant to say. These are big rotations, obviously, through some key support levels that many people thought were in the rearview mirror for good. And I think this is a tough learning experience for a lot of investors. This is what a bear market phase, this little couple week period where you just see a lot of distribution. You feel like bounces never amount to anything more than a quick, sudden one-day thing. And then the downtrend continues. This is what a bear market often can feel like. And sadly, I've been through a number of these. They're not particularly enjoyable from an investment perspective. However, there are things that are working, and what we'll look at a little later are things like consumer staples, utilities are actually holding in there okay. So focus on areas of the market that are actually finding stability and managing to show some positive returns. Let's look at a chart of the S&P 500 here and try to make sense of where we're at. So this is the chart we usually look at. We're quickly going to have to bring in some additional data because we're testing the lower end of the page. And I was always taught, never confuse the bottom of the page with support. The fact that we've now broken through 4,100 today, closing below 4,100 for the first time since, let's see, May of 2021 was the last time we were, almost a year ago, was the last time we were down at these down at these current levels that are closing below 4,100. That was the level we talked about, right? Those are the lows from February. Those are the lows from early March, from late April. The question is, can we hold those or not? I think the action today tells that's not the case. So where do we go from there? Well, we're actually closing already through the 50% retracement line. Let me add in a little more data so some of these levels make a little more sense. Here we go. So the 50% retracement, if we go to September 2020 to January 2022, which would be, maybe this much would be okay. Here we go. Now we see the September, October lows in 2020. That was the last big consolidation before the run higher into year-end 2020. 2021 was really just an exceptionally strong year with limited pullbacks. Pullbacks of over 5% were incredibly rare. Then 2022 has been a clear change from uptrend to downtrend. That's now very, very clear, I think, to most investors. We just today closed below the 4,000 level. Last time we closed below 4,000 was back here in March of 2021. So it's been quite a bit of time that we've spent obviously above this level and in the 4,000s. Now that we're back below there, anytime we close below a key support level, the question is, do we get confirmation? Do we get further validation that was just not just a fluke, that was not just a one big move, one big capitulation, that we get some further deterioration? So I think the rest of this week is pivotal in terms of understanding the dynamics of this market. But again, the fact that given the weekend, given an opportunity to sort of reset, we are not doing so. We're actually continuing to push lower. It tells me there's more downside most likely to be happening. Now, the downside objective I've been talking about, a number of my guests have mentioned, and I will say, talking regularly to peers of mine in the industry and the technical community, many of us have focused on this area, which is around 3,800 from a number of different approaches. But I think a couple things line up for me as a user of Fibonacci retracements pretty regularly in my work. Around 3,800, just a little bit above that, represents a 61.8% retracement of September 2020 to January 2022. And we've been using those levels fairly successfully so far year to date. The 38.2% level is right around 4,200. That was a key level we watched. The breaking of that was significant. We're now at the 50% level. If that does not hold, the next one down at 3,800, just above there would be a 61.8% retracement. That's also a 38.2% retracement of January 22 down to the March 2020 low. So the low after that big sell-off in February, March of 2020. So we've now, if we get to 3,800, that would be the first Fibonacci level using that framework. If we would bottom out around that level, that would be a very reasonable, very textbook use of Fibonacci retracements to understand short-term, but then also longer-term price objectives. I doubt it'll be that perfectly easy to play out. There's obviously going to be some challenge along the way, but that's why that level is so meaningful. And I think that's a reasonable one, because if that doesn't hold, then all of a sudden you're looking at some real beaten down levels. You're going down to 3,200 most likely, which would be the full retracement down to the September 2020 lows. That would also be a 61.8% retracement of March 2020 to January 22. So what happens here is there's an interesting symmetry using some of the key support and resistance levels and some of the Fibonacci levels that we refer to pretty regularly. So I think 3,800 might be a reasonable downside target. I put a video on my YouTube channel a couple of weeks ago with a choose your own adventure style look at the S&P 500. We are very closely mirroring the very bearish scenario, but also the somewhat bearish scenario. Go to my YouTube channel called Market Misbehavior if you want to look at that and see what those different scenarios were and how we sort of saw this potential move and how it's certainly playing out as we would talk about. Now, looking at elsewhere here very, very quickly, I do have to point out cryptocurrencies really feeling some pain. Many of the major coins that we track are down significantly. Some of them bounced here toward the end of the day. Bitcoin was down over 10%, Ether down over 11%, I want to say, a little bit ago. Bouncing up a little bit here going into the equity closing period, but testing sort of just below, right around 31,300, broke below 32,000 after breaking below 34 and 33,000. All today, we're nearing that 30,000 level, which has been a big round number. That's a Fibonacci support level. It's also the lows from summer of 2021. So we're sort of right at that sweet spot, sort of right at that potential support level. Let me bring in, I feel like I'm bringing in more data on most of the charts that I work with, and that tells you how much we've deteriorated. Look at the chart of Bitcoin in mid-2020. We're down here below 10,000. We accelerate to the upside. We pass all of these measures up to around 65,000, which is where we topped out in the second quarter of 2021. We then retraced about 61.8% of the way down to 30,000, bounced off of there a number of times. We've now retraced that all the way back. We retested the highs. We're now retesting the lows. What's interesting, I'm thinking of Peter Brandt, who was on my show maybe 5 or 6 weeks ago and looked at a monthly chart of Bitcoin and was sort of talking about this big range and saying we're in a huge range right now. And this takes some time. And then eventually we probably rotate above the upper end of this and Bitcoin does its next big leg higher. But boy, we are not in that environment right now. We're in a risk off phase where things like Bitcoin and Ether and any other sort of risk assets, to be honest with you, are all feeling pinched and all sort of rotate to the downside. So I think cryptocurrencies potentially here at some key support levels, particularly the Bitcoin and Ether charts I'm looking at, and pay attention to some of those big round numbers if you could. Fixed income markets are the last thing we'll be able to talk about here. When I'm looking at the chart of the TNX, we're currently around 3.08% or so. We came off. We were just nearing 3.2%. Earlier, came off during the course of the day as bond prices have been rallying. So the TLT, the AG, all sort of rotating to the upside. Certainly something to watch. However, this overall tendency of rates going higher, I certainly see as a longer term move here. What you saw today, you saw energy prices coming off with oil as well. We're seeing bonds start to rally as I think that ends up being a safe haven of sorts. We're now in the rounding error of the highs from the fourth quarter of 2018, which is around 3.25%, sort of in that range where you could consider this a big double top and you could get a pullback in rates that lines up with a rally in bond prices. That might be something we're looking at here, but let's pay attention to the chart and see if previous swing lows are able to hold. That's what I would be watching on the chart of the TNX and other fixed income instruments. We need to move on to our next segment, sector setups. Let's talk about some of the sector charts and what the 11 S&P sectors are doing relative to the benchmark. And the best way I know to do that visually is by using Julius de Kempener's RRG. This is the relative rotation graph. This allows us to look at the 11 S&P sectors, how they rotate around the benchmark there in the middle. The story in recent weeks, and if not months, as we've been looking at this chart, is general trend away from risk on assets to risk off assets when you're thinking of sectors, right? We're going away from offense and more into defense, away from growth and more into value, more into cyclical leadership. And if you look at what's actually heading northeast, which would be the direction of improvement on the chart, and this is looking at weekly data, so it's not just about the last week or something, it's more of a longer term view. Very few sectors actually rotating up and to the right. The handful that I see right now, actually the three of them, consumer staples, which is the only, which is this one here, materials, which is actually this one here, actually rotating up and to the right. And again, what that tells you is that they're outperforming in the fact that they're moving to the right and the momentum is improving. It's actually increasing that outperformance. And that's by the fact that it's moving vertically as well. So heading northeast is sort of the direction you want things to go, all else being equal. You can see how energy has been one of the strongest performers, still very strong relative to others over the historical data. But you can see in the short term, the trend is coming down, right? The momentum is coming down. The momentum is coming out of that trade. And today, really an exclamation point on the short-term deterioration in that energy with some of the stocks we'll look at after the breakdown significantly. Valero, Devon Energy, these have been strong leadership names that are pulling back aggressively in the last session here. Also worth noting, we never have time we rarely take the time to look at the daily RRG, but I would tell you if you're more of a swing trader, if you're more trying to understand the short-term dynamic and how it relates to the long-term, this is what you want to do. Change it to daily data. And you have to remember, this is not looking at a fairly limited amount of history now, but it is showing you the trends and how they're reversing. This is where you more understand the mean reversion, that short-term rotation in and out of different sectors. And this is where you can see things like real estate and staples, which have been strong performers in that short-term time frame, pulling back a little bit. Consumer discretionary certainly accelerating to the downside, given the weakness in a lot of those charts. Where you see the short-term improvements, utilities, energy up until today showing some strength, and materials as well. Materials has come up now on both of those timeframes, which makes me think if I'm looking for opportunities, I want to be in things where the relative rotation graph tells me assets are rotating, and it's a small number of sectors that are showing that kind of strength when we look at the RRG today. Let's look at the 11 S&P sectors using the candle glance function. We have the S&P at the bottom as well. And as a reminder, I think the candle glance function is a really good way to just spread out a series of charts and start to look for relationships. What's working, what's not working, what looks similar to other things, what looks different than other things. And it helps you to just understand that big picture using the 11 S&P sectors. Then we have the S&P itself here at the bottom. So the S&P clearly making a new closing low for the year. That's happening today, just before we're going live with our show at 4 p.m. Eastern. Other things that are making, or other sectors that are making a new low for the year, starting in the upper left, communication services. Now, this should not be a terrible surprise, only because we've been talking about the underperformance of communication services for a long time now. That is not a new phenomenon. The fact that it's leading this chart to the downside, not a big surprise, particularly thinking of some of the mega cap names that are struggling mightily there. Other sectors making a new closing low today: consumer discretionary, financials. Healthcare is actually not quite there. It's holding above there. Industrial is really, really close, but is indeed making a new closing low for the year today. Elsewhere, we have technology and real estate. The rest of these actually are not making a new low today for 2022, and those may be the areas that I would be focusing on. These are things that are holding up better than others. And in a down market, when it feels like everything's going lower, you want to be in the things that are outperforming. And so consumer staples certainly come to mind. The XLP has been coming down over the last couple of weeks, but certain stocks like General Mills and others are actually making new highs for the year today. Materials, while coming off fairly significantly, still well above their lows from February and March, while the S&P is already testing its low. Utilities well above its low from February as well. So again, while the S&P has gone all the way down and made a new low, utilities is holding up. And energy, by far, when you look at these 11 sectors here, the two that certainly stand out, or maybe the three that stand out as having clearly stronger charts than the rest, to me, would be energy number one. And then it's sort of a mix between consumer staples and utilities. These are the three sectors that are well above their lows from earlier in 2022, are nowhere near making a new low for the year. And most of them are above, or all three of those are above an upward sloping 200-day moving average. The rest are essentially all below that long-term trend gauge. So those would be the areas I would be trying to navigate to, and a place to potentially ride out some of the uncertainty that we've seen. Now, having said that, these are not perfect charts, and the challenge I have with any stocks right now is being is accepting the fact that overall there is a move away from equity assets. So if investors generally think they want to get all of their assets out of equities, they tend to be a little less disciplined about what they're selling when they're just trying to get out, or what they're selling where and at what point. It's more of a general move away from accepting risk and more of protecting from downside. And that tends to bring everything down a little bit. But when you look at this chart of consumer staples, you can see it's pulled back to an ascending 50-day moving average. You can see the relative strength is making a new 12-month high plus today. This is the type of chart that I would want to be hiding out in if I'm concerned about the future deterioration in risk assets. We need to take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close as we try to make sense of these markets together. These are challenging times, but we're here to help answer your questions, help you navigate this period. And I would argue I'm very biased by my suggestion that technical analysis and charting can always be of help to you, because I truly believe it can. But particularly now, when it feels like you're struggling to make sense of things, charts can tell you a great deal about what's working and what's not, and help you understand how these narratives you're hearing are actually playing out in the prices of assets. So it's a really good time. I'm glad you're joining us on StockCharts TV. I hope you're able to use the StockCharts platform to manage risk and think about your own portfolio in these challenging times. We have a couple quick announcements before we get to my next segment. First off, we welcome your questions. And as you're running into things, as charts are happening and you're trying to use technical analysis to manage this environment, use your email to get your questions in front of us. The Final Bar at StockCharts.com is the best way to get your questions our way. We're on Twitter at FinalBarSCTV. We're on YouTube. Put a comment below the video you were watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Tuesday's show of this week, also Friday as well. Also, go to StockChartsTV.com. That's our on-demand platform. I'm so proud of what the StockCharts TV team has done, working with our great contributors to provide an endless stream of market wisdom, of market commentary, and education to help you make sense of things. You can go to StockChartsTV.com, use your email address to set up a free account, start watching all of our content for free. You can also access StockCharts TV on demand on your mobile device. Let's continue on today's show. And Monday, it's three-pronged. We start with the big picture. We go to sectors. We go to individual stocks. And again, we're seeing further rotation away from risk assets. We're seeing volatility spike to the upside. The VIX moving well above 30 once again after toying around with that 30 level in recent weeks. Let's look at some of the individual names that comprise this market and what they are doing. I can summarize the charts of the 6 FAANG stocks, what I call the FAANG stocks, as this ugly or dismal or challenged. Is one of those adjectives is probably a good way to describe this. You know, any of these charts that have shown signs of life have failed to emerge with any consistent recovery. And I'm thinking of Amazon last week bouncing off of the 61.8% retracement level, having these big moves and a big gap higher, getting above 2,500. And it felt like, okay, this could be, I could see where that could be the bottom for Amazon. I can see buyers starting to come in. If this materializes and you string some days like that together, this market has a chance to really recover. We've now seen again that bounce resolve to the downside. So when the market bounces and you see some demand come in, and then the demand is immediately overwhelmed by additional need to sell positions and push the price downwards, that's a bear market phase. That's investors moving away from risk assets and just trying to get defensive and get out of these names. And growth sectors and growth stocks like Amazon are certainly struggling. Amazon, the problem with charts like this, it's now gone below that last Fibonacci support level. So just using Fibonacci's in a vacuum, the base case would be a return back to the 0% line, right? So you expect support 38.2%, 50%, 61.8%. If that fails, it's a 100% retracement would be the next potential step, which would take Amazon all the way down below 1,700, down to the low 1,600s. That's a long way. It's another 500 points from where we're at plus today. Now, do we get all the way down there? I don't know for sure. I don't, and I don't think that's what technical analysis is about predicting what level something may happen. I think using levels and being prepared for them is helpful, but as a trend follower, I'm most geared up to following the trend. And right now I see a trend deteriorating, making lower lows, unable to make new swing highs. And that's been the case for quite some time now. I'm looking at the RSI and I see how stocks like this are oversold. And again, that on its own just tells me we've gone down a lot. Stocks can go oversold and remain oversold for quite some time, just like they can go overbought and remain overbought for quite some time. So what you look for here is it exiting the oversold region. If you look back on the chart of Amazon, you can see the limited number of times when it's been oversold and jumped out of that region. It's usually been, at the very least, a tradable rally. At times, that is what the beginning of a big recovery starts to look like. And other times, it's a brief bounce before the next move lower. But in terms of looking for some opportunity of optimism, that's what I'd be looking for. When something's oversold like this, you look for it to get out of that oversold region, which would indicate at least enough buying is coming in to alleviate that oversold condition. It's not a complete flood to the exits, but you're trying to show some stability there. You know, elsewhere in this space, it's hard for me to tell which ones to look at as well. Microsoft is another one, sort of breaking down and bringing in a little more data here. So the challenge with the chart of Microsoft is we had this potential floor around 270. This is where Microsoft bounced off of in February and March. And again, in April, we've now broken down through that level of support. Now, this is still early on. This is just breaking down through support. And out of the 6 FAANG stocks, I mean, the two that certainly look the most constructive would be Apple and Microsoft. I almost combined the two into one technology conglomerate, but Apple is just testing 150, which would be the support level from March. It's the only one of the 6 that has not broken support because Microsoft did it today, closing below 270. Again, you look for follow through on that sort of move. Microsoft just breaking through support today. Does it follow through, tomorrow and the day after? Does it see further deterioration after the breakdown, or do you see buyers that came in waiting for that support level to be reached and now they push the price higher? That's the question mark here. But all else being equal, it's not holding support, and I would consider that more negative than positive. Let's also look briefly at things like Valero, I guess we'll take a look at. Down 8%. DVN is another leading name. These are some of the top ranked names in our large cap scooter rankings. Now, what's interesting is DVN is down 11% today. That's just this little blip. So you can see how strong this long-term trend has been. So the good news for a lot of energy stocks, they're pulling back, but they're still within the classic definition of an uptrend, making higher highs, and just Friday making a new 52-week high. So painful day today, but still overall, the volatility is extreme, but the trend is still fairly positive. Other names obviously failing to hold support and in more established downtrends in some of those growth-oriented sectors. So what actually is working? Is anything going higher? Yeah. And things like consumer staples, it's things like utilities, it's defensive and sort of late cycle leadership. People usually own consumer staples and you own utilities when they want to not own other things, right? These are not generally thought of as the juice. These are not the great offense names where you ride the bull market phase and profit when everything's going higher. These are things that tend to struggle in that environment, but tend to do well, because even if everything is a disaster, we still need to eat breakfast and use the restroom and all those things that consumer staples and other services like this really provide. And that's how you want to think of it. GIS, General Mills, making a new high today. And when I'm scanning for stocks with a scooter ranking above 90 in the consumer staples sector, I'm finding plenty, and it's a mix of things. Obviously, a lot of food products like Hershey's and Smucker's and others that we've talked about before. ADM is a name we've referred to, but also things like Altria and Coca-Cola and other beverages and others within the group. So there are charts that are working. This is where our scan engine, our alert system, can be really helpful to help remind you what actually is working, what stocks are holding up when the markets as a whole are deteriorating. We need to wrap today's show, though, and go to the three charts that tell the story of this market in just under 3 minutes. Let's get to the first one. We start with the chart of the S&P 500 in our the beginning of our show, in our market recap, sort of the macro portion of today's discussion. We talked about some of the key levels to the downside. I didn't get to them for the NASDAQ composite, the NASDAQ 100, but I've done similar exercises with those as well. The chart of the S&P makes a good amount of sense if you look at the bottoms from September 2020, you look at the low from March 2020, look at the all-time high at the beginning of this year, and look for some key levels of support on the way down. As I mentioned before, this environment that we're seeing in the last couple of weeks really mirrors sort of that very bearish or the mildly bearish scenarios that I talked about on my YouTube channel called Market Misbehavior. We laid out some of these scenarios and what it would look like. In a lot of these, potential support most likely is at 3,800, around that level. That's a key Fibonacci level using a number of those previous lows, but particularly the March 2020 to January 2022 high. That would be a 38.2% retracement. That would make a lot of sense from a technical perspective. That's a good potential place to revisit this market and see what sort of strength we might see. In crypto land, it's a lot of pain, and a lot of these were down almost 10 plus percent. Now coming up a little bit, Bitcoin only down 7% from yesterday, but still feeling a good amount of pain. I'm looking at Bitcoin here, the S&P there, and I'm looking at the correlation between the two. It was speculation at times that Bitcoin and cryptocurrencies could be an uncorrelated asset. And if you look back at the end of last year, there wasn't a lot of good relationship. There's actually an non-correlation, right? It's sort of a correlation coefficient around 0, which basically means there's no real good relationship between the two. Look at how these are very closely correlated now. Bitcoin is doing pretty much what the S&P does. It feels like the same group of investors deciding whether or not to take risk on or get risk off of their portfolios. Finally, there are stocks that are working. Our scan engine, our alert platform, our chartless features, these are all designed to help you identify stocks that are working in a difficult environment and help you identify some opportunities to lock in gains and some places to ride out this sort of market turmoil. Charts like GIS came up on my scan for stocks making new swing highs, on my scan for stocks that are rated pretty highly, looking at the scooter rankings, and you're finding a lot of consumer staples in the top 10%, the top decile of large cap names for good reason. These are stocks making new highs and relative performance increasing, relative strength improving, while the markets as a whole are struggling. If you want to navigate this environment, I would be clearly defining risk on areas of your portfolio that are struggling, some of the growth areas, and look for opportunities to be in charts where the relative strength line is improving. Consumer staples seem to be good examples of that. Folks, that's our show for today. Thank you so much for coming along this ride with us, particularly in uncertain times. We're here to help you make sense of things. Go to StockCharts.com to use all of these tools that we're showing today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.